What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is November 4th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, because in today's update, we got to talk about the massive decision from the Federal Reserve, not only to increase the federal funds rate by a whopping 75 basis points, but made it very clear that in future FOMC meetings that there is little to no chance of a Fed pivot, as they're full steam ahead towards taming inflation. Now, I want to talk about what we called for in the previous videos, what this all means for financial markets, but also talk about a big blind spot that I don't think many people are seeing right now when it comes to Bitcoin. We got a lot of things to dive into in today's video right after our quick sponsor. And our sponsor for today's episode is Integral. Now, for those of you who haven't heard about them, Integral is aiming to do something big in DeFi, building an automated market maker or decentralized exchange that allows for large institutional traders to be able to make the most effective, price-efficient swaps on the market. And on top of that, we've been following the developments of Integral for the past couple of months, starting off with our review as far back as May of this year. I'll leave a link down below in the description if you guys want to check it out. But we're really excited to launch a long-term partnership with Integral, as it is one of the few exciting DeFi protocols that's doing something big and is still filling a major gap within the DeFi space. So if you guys are interested, check out the link down below in the description where you can dive into the website, their docs, or the interview that we did with Integral and learn more about this exciting protocol that we're going to continue to cover here on the DataDash channel. Alrighty, everyone, so let's go ahead and start by trying to understand what the Federal Reserve did and said during this FOMC meeting. They first not only did what many people had already expected, which was that the Federal Reserve was going to raise rates by about 75 basis points or 3/4 of a percentage point. But on top of that as well, what many people really were concerned about or really interested in at the end of the day was to understand what the Federal Reserve, or more specifically, Jerome Powell, was going to say the Fed was going to do in future FOMC meetings, to try to understand whether or not the Fed was likely to slow down the growth rate of the federal funds rate during the next few FOMC meetings, rather than continue at 75 basis points at such an aggressive pace. But while the markets had priced in a pivot, while for the past month we've been hearing constant rumors and confidence from market analysts and the journalists who were in the room interviewing Jerome Powell to ask these questions of a pivot, we did not get that. In fact, we got a slap in the face, making it very clear that the markets need to wake up, that the Federal Reserve has gotten nowhere near its targets. And we talked about this for the past 2 days here on this channel. While a lot of people have been on board, while a lot of the headlines have been talking about a Fed pivot, we got a clear signal. There is no pivot and no pause. And I'm going to talk about why that is. There was a lot of different comments that Jerome Powell made during this meeting. And I understand sometimes the Fed can be boring, guys. I get it. But we need to understand the ramifications here and what it means for the broader asset markets. If we scroll down here, there was one key quote that really stood out and I think started to have a major weight on the market. Well, there was mixed signals where Jerome Powell did talk a little bit about potentially in the next meeting there might be a call for a slower rate hike, growth rate in the rate hikes. He did talk as well about being far away from their key objectives and metrics. The big thing that he said that stuck around and made it very clear that a Fed pivot, as people had imagined, one in which where we're reaching our target rate for the federal funds rate, where it's going to flatline and top out for some time, was completely thrown out the window when Powell said this, that incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. You can't put it more simple than that. Usually the Fed, their statements are usually blended in like absurd lingo. And I have to say, Jerome Powell's actually been a little bit better about this, at being direct. Some people in the past were very vague about it, but you couldn't put it more clear here, that they essentially are coming to the realization that they need to get ahead of inflation. They need to get on top of inflation, and they need to start raising at the same aggressive pace so that they can start to see the real decline in inflation that they're going to need in order to tame it in the long term. They're going to need to see softer labor market conditions, and they're going to have to start seeing slower economic growth that would be indicative of the reasons to start pivoting. Now, before we dive here into the charts, guys, I want to just make something very clear here. I'm not here to brag about getting the call right. I mean, we are pretty confident walking into this that the Fed has no room to be able to pivot. But I want to just say one thing, guys. If you happen to be a part of the pivot crew in this case, if you thought that the Fed was going to do this, and if you're here right now listening to me, there's no shame in getting the call wrong, right? I've made many wrong calls here on the channel as well, right? I don't want to act like I'm some saint in the market. And I understand if you were betting on the market bouncing up here, having some kind of rebound, I understand that can be painful here if you faced any losses, right? So put all that aside here, because if you're still here, it's all about learning from those mistakes, okay? And there's a big reason. Again, I just want to drive home why we were so confident on this call and why we've continued to stick in with tightening. It has to do not only with the fact that the data simply says the Fed cannot pivot. It just simply can't right now. We are still far gone from a position where the Fed can start to slow down, or what really I think the markets are hoping for, get to the eventual date on the calendar when we can start seeing rates go back down, where easy money comes back, right? We're far from that. But what's telling more than anything is how price action is trading here. The NASDAQ is facing resistance at its 200-week. This is a first in the entire decade here of the secular bull run that we started back in 2009. And on top of that, it can't even come up and retest its 200-day moving average. Let's take a look here at the S&P 500, right? When it comes to the indices, it's in the mid-range here, right? It's been holding up decently well, still above that 200-week, but had a major decline, about 2.5% after the FOMC meeting, setting in another lower high here and starting to press down close towards that 200-week. Now, the big savior here has been the Dow Jones. The Dow Jones securing 30 of the largest companies in the equity markets is likely one of the safer bets here when it comes to investing in the major indices. But even the Dow Jones, yet again, for the fifth time, deviated above the 200-day moving average and went right back down below. Now, if you guys know, we've talked about on deviations here on the channel, it likely means that we're going back down to new lows. We might get one more deviation, one more slight move back above that 200-day. But we've seen throughout history that this likely means we're going back down. We're going back down to the depths here. I know it's not fun, but if the Dow Jones is going there and the S&P 500 is close to breaking its 200-week and the NASDAQ is already facing resistance at what used to be the buy the dip opportunity of support, like it was in March of 2020 or here in December 2018, how painful are things about to get? How painful are equity markets going to get? Now, I know a lot of you are wondering, not so much about equities, curious about crypto, and we're going to talk about that. That's the big thing that I think people are missing here. I know I echoed that at the beginning of the video. We're going to get to that, but we've got to get to some of the charts here. Apple, one of those few defensive plays that have really been ticking up the Dow Jones over the past few days, down not only 1.75% here on Tuesday, but 3.7% on Wednesday, and another whopping 4.2%, wiping down the entirety of the past month of gains and looking like it's ready to go towards those 200-week moving averages. Google, down 45% from the all-time highs, and just from the past few days, down a whopping 13.3%. Meta, not only from the gap down on earnings is down, but on top of that, it's down another 9 to 10%. From where it was after that earnings report. And the big point here I want to drive home is that as a lot of people are possibly trying to buy the dip on these big technology companies, they think that, again, 30% discount, like it's been over the last decade, is usually a screaming buying opportunity. The game has changed. The secular bull market is over, folks, and I don't have any incentive to be bearish here. I want you guys to stick around and stuff. We're going to have lots of topics here on the channel. We're going to make money both ways. That's why this channel can still be valuable compared to a lot of the moon boys out there. A lot of people telling you that things always just go up, buy the dip. Unfortunately, that does not work when you're at the end of a secular bull market. We need to start looking towards more downside here. And the breach of that 200-week moving average is everything. It tells us all we need to know here. Take a look at history, and when you see a break on that 200-week, it gets nasty. And it goes on for some time. It's not me trying to be biased here, folks. Love the market to go up tomorrow. Trust me, DataDash does not have weight on the market. I'm not a big whale by any means. But I'm trying to help you guys as much as possible to navigate here. And that's why I've been drilling it so much here that we just got to hedge ourselves. We got to protect ourselves. If you want to have a little bit of crypto exposure, that's fine. We'll talk about why that's really fine here in a little bit. But the major thing here is to make sure you got some cash on the sidelines. That if the market dips another 50%, that you're not going to be financially ruined or set back years of progress that many of you have probably built up by being good about investing, by putting your money aside and saving, right? That's why it's very personal for me here. And again, I want you guys to do well, right? That's the big thing. But putting all that aside, I want to go ahead and talk a little bit here, again, about the confirmations here of how the market reacted, the deeper market metrics here, how the US 30-year yield reacted after the FOMC meeting, ticked up another 0.2% over the last few days, or excuse me, I'd say about 0.1%. So again, the bond market knew what the Fed was going to do, what it can and can't do. It is unchanged here. It knew what the Federal Reserve was going to do. And on top of that, dollar index ticking back up to new relative highs since back in late October, looking like it's about to break through what has been a multi-month bull flag here, a massive breakout pattern that could easily take us up towards much higher levels on the dollar here and possibly even give us our blow-off top on the dollar, right? I'm not doubting that we might be getting near one of the worst capitulation phases. We might be getting towards it, but it's about to get nasty before it gets better, folks. Now, we've looked at that, but while all the charts are screaming here that the Fed is going to continue tightening, I want to go ahead and talk a little bit about a chart that I think no one is watching. It's one we've talked about here on the channel. It's not brand new, but I want to emphasize again, if it's not on your radar, definitely make sure it is. And here's why. You guys know we love ratios here on the channel. We love comparing how one market to another is comparing. Not so much focusing on the dollar value, but which one is outpacing the other. Which one is maybe not being sold off as much as the other market. Now, one of the big things that we've talked about is the Bitcoin to NASDAQ ratio. Now, I think most people would agree, if we're being realistic here, while many of us might believe that Bitcoin is this kind of asymmetric asset, or it can be this asymmetric asset that's not tied to governments or per se economic growth, and it's this kind of digital gold in a sense that people could start to hedge their wealth with. I know a lot of people might think that, but for the broader market sentiment, Bitcoin is seen as generally the most speculative asset or investment when you're considering the broader umbrella. So I would say maybe crypto in this case is the broader, most speculative asset. If you were to put a ranking from bonds to real estate to equities and then to crypto, crypto would be on the risk side of that scale for investors. That's at least been the case for the past decade. But during this period of time where people are looking for a hedge that is not tied towards central banks or centralized governments, right? Bitcoin is one of the only few assets alongside gold that could potentially serve as a hedge. And while I gotta be honest, we got a really solid right call on the Fed's FOMC meeting back on Wednesday, I gotta be honest with you guys. You probably remember from the title we talked about being one of the biggest moves for Bitcoin. Gotta be honest, we got that wrong. We got that wrong here. And in fact, Bitcoin is ticking up towards its highest point here, excluding the wick here in July, its highest point since back in June versus the NASDAQ. Not per se in dollar terms, but against the NASDAQ. Now, to be completely fair here, Bitcoin did dip during the FOMC meeting, and it's, again, not up from the FOMC meeting, so I think there's something to be said there. And to be a little bit of a devil here, play devil's advocate. I don't want to be, I guess, a devil, but play devil's advocate, if you will. If you compare Bitcoin to the Dow Jones or the S&P 500, you get a weaker reading. You get lower highs here. But I do want to give some credit here where it's due. With major technology companies like Meta or Google or Facebook, or I guess in this case, Meta, Google, or Apple or Amazon, continuing to decline, with the tech stocks weighing below their 200-week and selling off pretty harshly. And crypto holding relatively neutral during this period of time. We'll pull up that Bitcoin chart here. Take a look at this, right? Bitcoin relatively unchanged from that FOMC meeting. And while I gotta say I'm worried about the 200 days crossing those 200 weeks, Could this be an opportunity for crypto to deviate, to break away from the 100% correlation that everyone has been talking about for the past year and a half, where crypto moves with equities? I got to be honest with you all and get a little bit interested. I'm not going to miss the train here if crypto starts to really break away. And I think one of the key signs you could look for is for Bitcoin on its NASDAQ ratio to get above both of these moving averages. If that happens, this might be something we need to have a little bit of exposure to. This might be where we need to get a little bit long on the market, have some exposure. And we could still have our tight stop set. So we're not going to lose much if things start to reverse or if this is just a temporary deviation. All right. So again, I want to be honest with you all here. Well, we took advantage of that August relief rally. We're always watching for signs here. And this is going to be one of the more bullish indicators out of all of the indicators. You can't point to much and say that things look bullish. But this is the one thing, the one little small hint that might come up into play for Bitcoin. And we wrote about this, to be completely candid with you guys, we wrote about this months ago in the Dash report back during the summer. We talked about watching this ratio. Right? So if you guys are interested in getting this kind of information, if you like this kind of analysis, you can always check out the Dash report down below in the description. We do a full macro report on crypto, equities, commodities, Forex, you name it. And on top of that, you guys will get my trade alerts. You'll get exclusive market updates. You get to join the Dash report discussion group talking to some of the most smart and bright people within our community. There's a ton of free stuff. There are a lot of valuable stuff that comes in there and stuff. And it's only about $30 a month. You guys can sign up on an annual basis and get 20% off. But really exciting stuff that I think might be valuable for you all. Now, the last thing I wanted to talk about that, again, I think is really big here is one of our partners, CryptoQuant, our data science partner here on the channel that we've been working with for some time. I spent some time, some spring cleaning over the past week, trying to clean up my dashboard and really put together my favorite data science models for the next few months, trying to potentially find when there might be a bottom in Bitcoin, as well as potential future tops. And this new dashboard I put together, which you guys can access for free on CryptoQuant at the link down below in the description, gives you a good oversight into some of my favorite data science models with some good descriptions on the data science models themselves, as well as what I like to look for within them and how they prove to be valuable for me as an individual investor. Featuring names like the Palm Multiple, Supply and Profit, the Korean Premium Index, and exclusive on CryptoQuant, and one of our favorites, the Net Unrealized Profit or Loss. I definitely recommend you guys add this to your tool, or your arsenal of weapons to try to figure out when the market is going to bottom, when it's a good time to get in. And again, we're watching these right now as we talk about this conversation around potentially Bitcoin breaking away, potentially starting to show strength. Check out the link down below in the description. Like I said, it's free. You guys don't have to pay for it. You guys can try one of the price plans, but again, it's about just trying it out, seeing if it's for you. Last thing I'm going to talk about before I start to lose my voice here is talking about the chart that no one is watching right now. The last big little tidbit I want to give you guys. Right, we talked a lot about inflation and the Fed trying to tame inflation and bring back supply and demand into equilibrium to bring down prices. Take a look at the crude oil futures here, folks. We're tracking between the 200-day moving average, which could serve as resistance. We've got the 200-week moving average coming up here as well to potentially act as support. The major thing I want to drive home here is that oil is continuing to remain elevated. We should be seeing, with the decline in the U.S. Strategic Petroleum Reserve, right? This is one of the huge strategic crude oil reserves that the United States owns in order to unload supply into the market to help weigh down prices, to have some negotiation weight when it comes to OPEC and other nation states. With the massive reduction of the Strategic Petroleum Reserve over the last couple of months, to see oil still sitting at $90 a barrel, if this starts to break past these moving averages and go above $100 a barrel yet again, it's time to batten down the hatches. This is the one thing that could kill that opportunity, I think, for really Bitcoin to take off. Maybe Bitcoin could still take off then, but it's really got to make a big move during that period of time to show that, hey, it's very clear the market now sees this as a hedging asset, not a risk-on asset. But I can't tell you guys how painful it will be for equity markets if oil breaks back to $100. you need to keep this on your radar. If you've got TradingView, again, free tool you can watch and utilize, or any other charting tool, keep an eye on crude oil. We're going to talk about this a little bit more on the channel here over the next coming weeks and months. But that's it for today's video, guys. I've rambled on long enough. If you enjoyed the video, drop a like. It's one of the best ways you can support the channel. And again, you can always check out the links down below in the description for the tools we talked about, as well as check out Integral, one of the projects that we're going to be working with long term here on the channel. But until the next one, everyone, thank you all so much for watching, and I'll see you all in the next video. Take care, everyone.